Interesting. I believe we're live, but I had a different microphone set up. So last minute switch. Now you're definitely going to have to let me know in the comment section if you can hear me. I can see my little bar going off, so I'm just going to make the assumption we are live. Thank you very much for joining me. Volatility Barometer episode 63. If you're wondering why it's called the Volatility Barometer, that's essentially my volatility metric that I calculate within the VTS community. We call it the Volatility Barometer. So it made sense to call the live streams the same thing. Sometimes people ask, well, where does that name come from? I can actually even show you really quickly while people are just coming in here. Let's pause the YouTube, mute that for a second. The Volatility Barometer, we basically have a few strategies that monitor this. This is, I think it says 13. Well, it's actually 14 different metrics right now that combine into this volatility index. In my opinion, of course, far superior to something like the VIX index or any individual metric like VIX Futures. But yes, that's the Volatility Barometer. That's where the name of the live streams is coming from for those people that were asking. Somebody just asked in the email just a few minutes ago. So thought I would just get that out there. Another quick note before we get into it. So in the YouTube analytics, just looking on the back end, this is something that I've never really looked at. I've always kind of considered them vanity metrics and whatnot. But it's actually probably a little more than that. And it turns out about 60% of the people that watch my live streams and watch my videos aren't actually subscribed to the channel. So they're coming through, they're watching the stuff, and I can even see if people return, and it does seem like people who are unsubscribed keep coming back. So if you could do me a favor really quickly, just hit the YouTube subscribe button. Like I said, it's not entirely a vanity metric. There is a plan in my mind down the road to start doing interviews with people, to start doing collaborations with some other people you might know in the volatility space. And of course, you know, as it happens, the more subscribers you have, the more likely it is you will get to secure some of those interviews with larger names. So absolutely subscribe to the channel if you want. Don't super chat, don't pay any money. Everything's free here. But that is the payment. Subscribe to the channel. And of course, give me one of those. Give me a like. Does help. Helps YouTube algorithm push everything out there to everybody. So, you know, makes them think I'm a little more popular than I am. So what we're going to do today, I've got 2 segments. I was going to do 3, but I think the third one might be a little long. So I'm going to do maybe a midweek live stream next week. And we're going to talk about that third thing that I had in mind, all about leveraged volatility ETFs and leveraged ETFs like the TQQQ for the NASDAQ. I get a lot of questions on that stuff, so I want to dedicate a full live stream to it. But today we're going to continue on with our Wheel of Fun trade. So hopefully you tuned in last week. We're right on the edge right now. I'm just going to open up the software in a second. We'll see where that trade's going to land. It's actually very, very close. We're kind of going to have to force something here. But after that, we're going to talk about the VIX Futures and one of the most common misconceptions about actually what happens surrounding the rebalancing and exactly what Contango means with respect to the VXX, the UVXY, whether it actually causes their movement or not. And then, of course, start getting your questions into the chat right now. And I can see there's a few there. Yeah, we'll get to all your questions. I always stick around until I'm completely through the list. So let's get started with segment 1. Wheel of Fun strategy. So just a quick recap. Before I actually open up my software and see where that old VXX is trading, I want to recap everybody from what happened last week. So the Wheel of Fun strategy is super basic. I'm sure you've seen it in some variation. I call it the Wheel of Fun. This is just a thing that I called it many, many years ago. It just kind of made sense that there's a wheel that's going around. So that's what the strategy is. But you start by selling a cash secured put and you collect some premium. So with this strategy, we don't care what the underlying value of the stock or ETF actually is. It is just a pure premium collection strategy. We're just trying to grab some premium on the front end, maybe on the way out the door on the back end, and then get out of the trade and repeat the cycle. So the first thing we do is we sell a cash secured put. And we sold ours at 23.50 on the VXX. Okay, I'm very curious in a second where it's sitting at. You'll see in a minute. But 2 things can happen. So it can expire in the money, which would basically mean below 23.50. If that's the case, then I will get assigned my shares today, and I will be holding long VXX shares. But another thing that could happen is it could expire over 23.50. We would call that out of the money. In that case, I just keep my premium from the put. I'm right back out into cash. I do not get assigned the shares, and I would just go around this mini wheel until I do get assigned the shares. Once I do, we go to the next step where we sell a covered call, again bringing in premium. And that is always ours to keep. No matter what happens to the trade, that premium is ours to keep. And then again, two things can happen. It can either expire in the money, in which case the covered call is in the money, your shares get called away from you, you're right back into cash, and you could cycle right back down to step one if you wanted. Or, as I spoke about last week, the entire thing can be done on call options as well. You just start with a cash secured call instead of a put. So when you hit this fourth stage, you kind of gauge the pulse of the market and you decide where your next target is going to be. But this would put you back in cash with a full cycle. Or it expires out of the money, in which case you keep your shares for another cycle, you go right back and you sell a covered call, and you go around this wheel for a little while. Hopefully, one or two cycles, maybe 3 or 4 if you're lucky. And then eventually you can collect a pretty good chunk of premium and you're out of the trade. So as you can see the wheel. So this is a perfect situation here. You would sell a cash secured put, collect your upfront premium, expires in the money. The very next cycle you sell a covered call, you're out, you got your premium, and you're back in cash. And then again, find another target to do this on. So let's check out where we are at right now. So S&P 500 is up 0.27%. which puts the VXX at 2340. So remember, I said that we sold one. You can see right here, I've got a position with 0 days to expiration. That's here. We sold the 2350, and it is just barely in the money. So this little hash line right there is the VXX. So I would say that, look, the live stream happens during market hours, of course, so this is not an expiration value. But we're just going to assume that this is the expiration price, and I'll clean it up later if it doesn't actually land there. I'm in Dubai right now, so it's the evening, but I'm going to stay up until the market closes just to make sure I can clean this up and make it look good on the front end so that next week we've got an actual valid trade. But this is pretty much a perfect situation because we sold it when it was over here. Actually, we sold it when it was in the 2450 range. We got a little bit of premium. We got 36 cents, and we sold the 2350 put. And we were hoping that it expires at 2349. Essentially, we would get assigned 1,000 shares because I have 10 contracts here. Remember, one option contract is 100 shares at the underline. I'm hoping that it expires at 2349 so I can turn around and go to step 3, which is sell this covered call and get a bunch more premium. So it's pretty close, right? This is a pretty ideal situation as it sits right now. My cost basis, including the 36 cents, is all the way down here. So I'm up money already. Even though I'm going to get assigned the shares, we are up money. And a very important thing that I do just want to cover really quickly here, of course, when you're selling put options, you are not reducing your downside risk very much. You're really only reducing your downside risk by 36 cents that I collected on the upfront, which isn't very much. So essentially, you're on the hook for the full downside of anything you're doing this on. So you need a stop loss. And what I do is I use a 10% total value stop loss. So this trade, I dedicated a certain amount of capital to it. If it's down 10% or more, I just cut my losses and I'm out. I don't try to save it. I don't try to roll things forward. I don't try to rescue what's gone badly. I just take my 10% and I go on to a new target. But that's all the way down here. I mean, the VXX, these are weekly cycles. It would never happen, right? It has to build to that over several weeks. But it is there. The stop loss is always hovering there. But the important thing is today, we can actually just assume, as of right now, 2341, the VXX has expired. Again, I'll clean that up at the end of the market. So now what I'm going to do is I'm going to turn around and assume that I have 1,000 shares of long VXX, and I'm going to sell a covered call. So 7 days out, which means I will be back next week for a live stream next Friday, of course, to clean this up. This was the put side. I'm going to go ahead and play on the call side. And remember last week I said that if you actually get a reasonably good expiration, something close to the assignment value of 2350, you can actually get more money for the covered calls than you can for the cash secured put. Now, I didn't mean to give the impression, because I had somebody have a follow-up question. They said, well, how come covered calls pay more money than the put? I probably should have been more clear about that. It's not that the calls pay more than the put. It's just that when I initiate my original trade, typically I'm not right at the money. Sometimes I am. Sometimes you just want to bring in more premium, but maybe I'll go a strike or two below on the put. So I got 36 cents. But right now, because I'm getting assigned at 23.50, I can go as aggressive as I want at 23.50. And I'm going to obviously bring in more money. If the VXX right now was at 22.50 and I sold a covered call at 23.50, probably would only be 36 cents. But as it happens, we got a pretty good expiration because we timed this out. And of course, shameless plug, if you want to join the VTS community, we do, of course, track these numbers every day, and I give them in the VTS community. The 1 day, 5 day, 10 day, 21 day, the anticipated decay factor of all the pricing that's going on here. This is, of course, based on how the volatility ETPs actually derive their value. So this is not just a random guess, of course. This is, the calculated best estimation of where these are going to be going forward. And last week, if you rewatch that live stream, it basically said it would be at 23.50, which is why we ended up at this price. But now I can get that aggressive 23.50 covered call, and I can get what looks like about 64 cents. So I'm going to go ahead and sell. Oh, that's not the right tab. Let's go into this one. 7 days. So next Friday, I'm going to sell this, and let's see if I can get something close to the mid. So now this is where the 30-second rule kicks in. Make sure that I have 10 contracts. I don't want to fat finger this. 10 contract. See, there you go. Got to pay attention, especially when you're distracted on a live stream. Sell 10 covered calls at 23.50. All right, good to go. You can see right here we got the mid price at 63, natural at 61. I don't want 61. I'd rather get 63. But let's go ahead and use the 30-second rule, which means I want to actually try to get slightly better than the mid. When you're selling something for a credit, you want more money. You want to bring in more. So I could go to 64 and I can just give this a shot. What I would do is I would watch it in the queue. I would wait 30 seconds to see if the computers actually line up correctly and they give me my trade. Probably not going to happen. But again, if I was on my own, I would just go ahead and wait the 30 seconds. Today, I don't need to. All you really do is just drop it one of the smallest increments. So in this case, it's a penny. But sometimes when you're trading options, it could be a nickel. And there you go. I did get the mid at 63. So we are good to go. Now, like I said, this isn't actually expired yet. I'm going to wait till market close and clean that up. I may actually have to just go ahead and buy 1,000 shares. If this expires over 23.50, of course it expires worthless, keep my premium, and I'll just go ahead and buy 1,000 shares so that next week it's going to look like I have a covered call. I'm going to actually simulate and force this thing to happen. Because like I said, we've done this. This is our 4th time doing the Wheel of Fun system here. And this is the first time we've actually had some action. The first 3, we just sold the put. It didn't expire in the money, and you're just out of the trade, which I suppose some people might think that that's the goal of the system. You just want to sell a whole bunch of short put options, have them always expire worthless, and you just keep churning that. But what you will find later on, if you do more of these trades, is you do actually want to dance around that expiration cycles where you are assigned the shares. You can actually bring in more premium. It's not more risky because remember, we're using a 10% stop loss, but I actually do want to occasionally get the shares assigned and do 2, 3, 4 cycles of covered calls. And we know that the VXX does decay downwards. So you might be thinking, wow, now he's got 1,000 shares of VXX long. You got to remember that I have 63 cents plus 36. I'm basically at $1 of my cost basis. I'm already down at 22.50 and it's only a week in. The more this goes, the lower that cost basis goes. So essentially, I don't want to give you the idea that it's a race against time or anything, but you're essentially, when you use the VXX, or sometimes I use UVXY, we know that it's probably going down. But my goal is to collect more premium than it is decaying downward. That's the goal. So we are only 1 week in, so we're dancing pretty close to the expiry or the assignment value, but it could rise to a situation where I actually hold the shares at 23.50 and the VXX 2 months from now is at 18, something like that. And the covered calls I'm selling, I'm not going to be selling the 23.50s. I'd be selling the 20s, the 19s, always following it down, just making sure that I'm always bringing in more premium than the shares are losing. So might sound bad after week one, but trust me, we're off to a pretty good start here. And I think you'll get the idea for this strategy quite quickly. So let's just check out what step we're on. We are right here. We're at step 3. We just sold this covered call for $23.50, which means either next Friday it expires over $23.50, in which case trade is over and I made $1. If it expires below $23.50, then I keep my shares and I will do another covered call. So we will revisit that. And the last thing that I will mention, of course, as with all investing, with all trading, you really are better off doing several smaller trades rather than one big trade. So for example, our VTS Iron Condor strategy within our portfolio, we allocate the positions down so we can take potentially 3 different trades open at the same time. It's always better to do 3 smaller Iron Condors than 1 big one. So with the Wheel of Fun, if you like what you're seeing here, and you can go back and check out the live streams, we've done these several times. If you like the strategy, if it sounds like something you want to play around with, what I would suggest is you divide your capital up into much smaller pieces and get 3 or 4 of these going at the same time, these wheels. You don't just do one giant VXX, you do a VXX, start a wheel on gold, start one on the TLT, start one on the NASDAQ or the Russell 2000. You get the point. You can do these on anything, but if you can build a portfolio of smaller positions, all of them with lower than 1 correlation to each other, now you're talking about a diversified Wheel of Fun strategy. So that would be the goal. Don't think that you just have to dump all your money in one and then just watch this thing go. You can obviously target different correlation, different exposure factors, different leverage factors, all these things. Diversification, it really is your friend long-term if you're an investor. So yeah, we're good. Happy that we finally got one. And like I said, next Friday, you're definitely going to want to tune in. We'll see what happens. Hopefully it expires. So now you might be wondering, well, now what's ideal? I told you 23.49 is the perfect expiration. What about next week? Well, next week, I would also like it to be 23.49. That way I can keep my shares. I, of course, keep the $1 I've already made, and I can sell another beefy covered call at 23.50 right at that threshold line. It's probably going to bring in another 60 or 70 cents. So you get the point that if you do get a little lucky and you carry this thing through, even if it bleeds down a little bit, yeah, this can really start to add up. So we're good to go. We're off to the races. All right. Uh-oh, what did I do? I'm always clicking around the wrong buttons here. So the second subject, this is an interesting one. So this is one that I'm just going to kind of give me some leeway to talk through this one because there's 3 or 4 points that I want to make within this larger segment. So, and I'll try to, some of you are going to be rolling your eyes a little bit on the first part thinking, well, yeah, who doesn't know that? But just bear with me. There's going to be a few lessons along the way, hopefully for everybody. But the reason that I'm going to be talking about this is last week, I actually answered a question in our live stream. This gives me a chance to plug my other YouTube channel. So it's always good to plug your own stuff. Shameless plug, but there it is. I actually have a clips channel as well. I'm not sure if you're aware of that. If you're the type of person that likes shorter clips, it basically is coming from my videos, live streams, the questions, but I just pick out the best 2 or 3 minute segments of each thing and I chop them up as clips. And I do edit them, so they are more pleasant to watch than just a rewatch of my live stream. But I do have this, and I am going to go ahead and drop this. What am I looking at there? I can play that as long as the sound is off. Okay. Anyway, I'm going to drop this right in the chat. And if you want, you can subscribe to the Clips channel as well. No, you don't have to. No pressure. This is the main channel. I do appreciate when people subscribe to this one and, of course, give the live streams a like. But as I was saying, in this one, last week I answered this question about the VX30 to VIX roll yield, and I mentioned in here that the level of contango doesn't actually affect the volatility ETPs during the rebalancing. So there's a lot of people out there that seem to think that because, actually I'll show you a picture of the VXX just so we're all caught up here and we can see how diabolical this all is. Close all these windows. What are we looking at? We know what the VXX looks like, right? So diabolical obviously goes down long term. This is what we're all trying to profit off when we are short volatility traders. And we know this is happening. But for some reason, there's a lot of people who think what's actually happening is that during that rebalancing, that the funds are somehow realizing their losses or realizing the gains during that rebalancing, and that's sort of dragging it lower and lower each day. So as this incorrect line of thinking goes, as I want to state very clearly, this is not actually what's happening. So get that clear. I don't want people to chop this up and go, wow, this guy doesn't understand what he's doing. Again, I'll make clear this is not what's happening, but people think what's happening is because the volatility ETPs derive their value based on the front two futures, right? So essentially what happens here is on the first day of the next monthly cycle, the VXX is holding 100% of the front month future and 0% of the back month future. And then every day as we move towards expiration, there's typically around 20 trading days per expiration cycle. It sells a little bit of the M1 and it buys a little bit of the M2. And this happens throughout the cycle. And at the end of the cycle, this future will equal the spot VIX. Those will converge. Again, I always remind people it's not useful to say it has to go down. It could also, the VIX can go up, but we just know that they will converge and it will be holding 100% of the back month, 0% of the front month. This one will expire. The M2 will become the new M1 and the cycle will repeat. It'll be holding 100% of the new M1, 0% of the new M2, which was the M3 that came down to M2, rinse, repeat. So this is what I'm going to say right now is incorrect, but people think that at the end of the day, because it has to sell some of this one and buy some of this one, this price typically is lower than this one because 84% of the time the VIX futures are in contango, which means this curve is upward sloping. If it's selling something cheap and buying something expensive every single day at the end of the day, surely it's realizing those losses at the end of the day and it's losing money, right? This is what a lot of people think. And I've seen YouTube videos and articles and people talking about this, that, boy, look out for that end of day rebalancing because this is why the VXX looks so diabolical. I do want to stress that I will get into what happens when you have an extended period of time of a contango curve, but we do want to be perfectly clear, nothing happens during the rebalance. This is the part where you might roll your eyes, but you'd be surprised how many people don't know this. So let's check out an example. First of all, let's remove volatility completely from this equation, and we will just do a two-stock portfolio rebalancing example, and you'll see right away that, of course, nothing is happening. So let's say a person has $100,000. They have 50% Apple, 50% Tesla, and they want to do a rebalancing. They think that Apple's going to be the better company going forward, starting tomorrow, so they're going to do a rebalancing. So they're going to take 60% of this. Of course, what that's going to mean is this is going to drop down to 40% of Tesla. Now, all that happens is you're changing money from the pile that is called Apple, or from Tesla, into the pile that's called Apple. So as you're doing the rebalancing, you're going to just have less shares of Tesla and more shares of Apple, but you're taking the capital from this one and you're putting it into this one. So nothing happens to the portfolio value, of course. You're just moving money from one pile to the other. When you do this rebalancing, which would take, what, a minute tops? During that 1 minute, the net liquidation value of your portfolio has not changed. It does not matter if you're, I'm doing air quotes right now, realizing the gain or loss. Nothing is actually happening to your net liquidation value. That's only happening over longer periods of time throughout the trading day, right? So of course, after the rebalancing happens, when the market opens the next day, it's going to start moving around. And throughout the first trading day, yeah, you're probably going to see your portfolio value changing then. But that's the key point. It only changes when the actual value of the underlying stocks change. It doesn't change when you, air quote, realize a loss. That doesn't matter. It doesn't matter if you took a massive loss on this or not. That's already happened. The rebalance is a net zero transaction. So of course, if you go to the M1 M2 futures, it's the very same thing. And so fortunately in this case, there's actually a little formulaic aspect to this where we can actually go to the iPath website and we can see exactly how much of the M1 and the M2, the VXX, is actually holding. So you'll see here when this loads up, you got a bunch of ETNs here. We'll select the VXX. And you can see the first thing is that the VXX currently has $433 million of assets under management. Great. Then you can also go look at the holdings, and we can see that it's holding 90% of the front month and 10% of the back month, right? So that's 90-10 right now. And just so you know, that's not always the case. It's just this month it's actually worked out pretty clean. So you can see that this month there actually is going to be exactly 20 days during this VIX Futures expiration cycle. So if you're wondering how that is calculated, essentially, as a rule of thumb, you can always assume that the VIX Futures are going to expire on the third Wednesday, basically the Tuesday night, but there's this rather weird settlement process that happens, so it actually settles Wednesday morning. But let's say the third Tuesday at market close is when the VIX Futures officially stop trading, right? The third Tuesday. But what's actually happening is it's 30 days before the next month's S&P 500 expiration cycle. That's how that's calculated. So it will always land on the third Tuesday unless there's a holiday or something in the S&P 500 cycle, and then it might be different. So it's not always, but basically rule of thumb, you're looking at the third Tuesday every month. But you can see that this month it worked out clean. So we're losing 5% every day. That's why it says 90-10. But some months have 19, so it's a little bit more on the rebalance. Some months have extended days, 23. It averages about 20. But as you can see, this is very clean, 5% a day. We just started the new cycle, so that's why it's basically holding mostly M1. Remember I said this whole thing, we're going over this because basically VXX, this is going to happen. Sorry, watch this. I have to reset this, 4 times? I do this all the time. I have to reset that because the ad blockers and whatnot. Okay, so it's holding 90% of M1, 10% of M2. So there's a little point here between them, but mostly on M1 we call VX30. Not overly important right now, but VX30 is the value. So what happens at the end of today? What happens when they want to actually go to 85% of M1 and 15% of M2? Well, all they're going to do is move a little bit of this capital into this one. Nothing happens to the value. The realization of the gains and losses has already happened throughout the day, of course. So the rebalancing itself is a net zero transaction. It's still going to be the same net asset value. VXX is not, how you would say, chunking down pricing at the end of the day because of the rebalancing. I've actually read articles where people were talking about how you should close out your positions 5 minutes before the rebalancing so that you don't get that chunk. I don't know where people come up with this. You're just moving something from money from here, a pile called M1, and you're moving it to this pile called M2. The only way that that would cause any change in the net asset value is if there was some type of influx of capital, but in the 1 minute that you were doing the rebalancing or something, like the fund suddenly just decided to throw some more money in there, which of course doesn't happen. So net zero transaction. That's just what it is. Of course, the rebalancing is a non-issue. Just ignore it. There is no benefit to selling right before. There's no benefit to trading the rebalancing, as you might have seen YouTube videos talking about. It's all nonsense. Rebalancing is always a net zero transaction. But the other thing that came up during this video that I put out, where it was specifically talking about this buy high, sell low dynamic and debunking it. But you can see when I hover this, it says Contango doesn't matter. Of course, that triggered a few people, and I had some comments. Of course, they're saying that Contango is what's causing the VXX pricing. So now we're going to talk about that rabbit hole. Is Contango causing, and I'm going to stress that word, is VIX Futures Contango causing the VXX to go down? And for my mind, you might think this is a semantic argument, but I really don't think it is. I think from a trader's perspective, this is quite important, that The only thing that causes movements in the VXX, the UVXY, the SVXY, SVIX, pick your poison, they're all the same. The only thing that causes the movements of those products are the movements of the VIX futures themselves. That is it. That is all. Full stop. What happens tomorrow after the rebalancing, markets open, or not tomorrow, I guess, Monday, is basically a free market. The VIX futures are a totally free market. Contango, if the VIX futures are in Contango, the VXX can still go up. It happens all the time. This is why I think this is an important distinction, because there's a lot of people out there who actually have been told or have the impression that to succeed in this trading world of the volatility products, you just short the products when they're in Contango. And suddenly, of course, Contango causes them to go down and you're going to make a bunch of money. What they find very quickly is there's an enormous number of days where that doesn't happen, right? The VIX futures are in Contango and the VXX goes up. What gives? I was told that as long as it's in Contango, I've got this tailwind and I should be making money. You can lose 40, 50% of your capital in a massive drawdown while the VIX futures are in Contango the whole time. That has happened before. So we do want to actually talk about this a little bit further. So got another little quick spreadsheet here. Which one am I looking at? This is not the right one. My spreadsheets, as you all know, they crash my computer. So let's check out Master Volatility 5. Just give this a second. I have to separate all my spreadsheets out because some of them are pretty extensive. And if I have it all in one, it'll freeze up. You can see it beach balling already with this. Okay, so what I did here is essentially just to try to highlight this point. The first question you might ask is, okay, well, how often is the VIX futures actually in Contango? So here's the Contango, M1 M2 VIX Futures, and I split it up into 3 columns. You don't actually have to do this, but it's better visually for a live stream. So a check every time it's in Contango, the running total days, and then the percentage compared to the percentage of total trading days. Turns out the VIX futures are in Contango 83.61% of the time. So if the VIX futures are causing the movements of the VXX, certainly the VXX is basically going down 83% of the time, right? That's what one might assume. But the second thing that I calculated is, well, how often is the VXX actually down? How many trading days? Well, again, separating it into 3 columns, so you can see it. It's actually only 57.88% of the time that the VXX is a negative day. So it's actually going up 42.12% of days. You might think, well, that's weird. Like it's in Contango almost 84, but it's pretty close to 50-50 split as far as the daily movements. So I don't think it's very useful to say that it's actually the Contango that's causing this. So then the last follow-up question you might ask is, well, how many days is it going up when the futures are in Contango, right? That's the real question, because that should spike up a lot. And it's a slight improvement, like it's not even 3% difference, but let's just call it 3% additional number of days based on the Contango level. So yes, of course, there's a correlation there. This is why I'm going to make this distinction between correlation and causation. But you should not assume that Contango is somehow causing these movements, because it's not, of course. The VIX futures are a freely traded market. All market participants can do whatever they want. Contango doesn't do anything to the product. It's just a historical measure that probably more often than not gets you on the right side of the trade, and it's one step further to being profitable. But you can see it's really not a giant leap or anything here. So essentially the point that I'm trying to make is when we are looking at these metrics, and of course I'm all about metrics. I've had many articles and videos talking about Contango and the value as a filter for short volatility trades. But any of these metrics that we're talking about, my cash VIX oscillator that I designed, talking about the VX30 to VIX roll yield, another one that I think is fantastic, which I talk about a lot, the cash VIX term structure. A lot of people know what the VIX index is. It's a 30-day volatility calculation, but there's also a 9-day, 3-month, 6-month, and 1-year VIX as well. Same calculation, just different time frame. The differences between these is very instructive on how we're going to short these volatility products. But the point is that all of these, every metric that I just ran through there and mentioned, every single one of them is a correlation. It's a historical correlation that when this condition exists, it is a little bit more likely that the VXX is going down. That's what we're dealing with here. But it is not accurate at all to say that that metric is what's causing it to go down. You get, kind of get the point. I don't know if this is going to be flagged for violence on YouTube, but for some reason, because I'm a UFC fan, I'm a boxing fan, so for some reason, punching someone in the face kind of made sense as an analogy. But I told somebody, like, it's basically the difference. Let's say I punch you in the face, right, and you get a black eye. The person who's saying that Contango causes the VXX to go down would say that, I got angry and I punched you in the face and gave you a black eye. That person would say that what caused his black eye was that I got angry. That's not actually what caused the black eye. The anger just makes it slightly more likely that I would have punched you, right? But lots of times people get angry and they don't punch somebody in the face, right? So your black eye was not caused by the anger. That's not helpful to say that. What's helpful to say is the fist to the face caused the black eye, and that's it, full stop, right? It's not really helpful to try to jump a step further out and say, well, every time somebody's angry, you're going to get punched in the face. No, you're actually not. So there's no causation there. VIX futures, cash VIX term structure, even my favorite VX30 to the VIX roll yield. There's no causation at all here. It is simply a correlation that we know that if, and I don't like to look at one, I like to look at 10 different metrics. If, check, I've got all those green lights going, okay, now I can short volatility, and I have a slightly higher chance of being on the right side of the trade. Hopefully bigger than slightly, hopefully a significantly higher chance of making profit. But yes, correlation, causation, this causes problems for people. And I think as a trader's mindset, you want to be explicitly clear on the difference between those two things. Because you can get really blindsided if you're expecting, oh, this causes this, just look for this condition. That means that there's money to be made here. It's a direct A to B calculation. Well, it's really not. There's a lot more going on there. So to all the people, there wasn't that many, 2 or 3 people, who pushed back on that, what I will say is, of course, Contango is one of 5, 6, 7 things that you want to be looking at. There is definitely a historical correlation there. Like I said, it's about 3%. It's not overly impressive, but it's there. It's something. So, yeah, don't think that I said, oh, Contango's totally worthless. Remember, that video was actually about the buy high, sell low stuff, which is, of course, nonsense. So here we go. Let's go into the Q&A. So how long did I do that? Next week, I'm going to talk about leveraged ETFs, and I think that's going to be interesting to you guys. So let's rip through these questions. I think I actually lost a question. Sometimes when I go live, I lose a question. Let me go right to the top. I'm going to have to read this one because I'll show you what I mean. Of course, I'm going to have to read them, but sometimes I can like click on the question and you guys can see it. But when I went live, I lost the first question in the stream. So I'm going to, you know what I can do? Come on, technology. I can actually just show you. The question right here, it's this one. It says, why is ZIVB using M4, M5, M6, and M7? Wouldn't be easier, better to have only 2, M4 and M7, in the calculation, and how the rotation between M4 months looks? Okay, so that is a way of saying pretty much every volatility ETP that we know of, right? The usual suspects, VXX, UVXY, they're all playing in the front 2-month futures. But the new one, which arguably isn't new at all because it's a recreation of the old one called ZIVB. The old one was just ZIV. It was launched in 2010, November 29th, 2010, I believe. And it was delisted in, July 20th, 2020? Something like that. And now recently the ZIVB is back. Well, the ZIV uses M4, M5, M6, and M7. So his question is, well, why would you use 4 of them? Why wouldn't you just use 2 of them? It's just the way that they did it. They're playing in the middle of the term structure. So how this works, remember the front one, it's using only these 2. So it goes from 100 of this one to 0 of this one, and then it moves it forward over time to the point where this is at 100, this is at 0, it expires, it goes worthless, and this is the new M1. Well, the M4 to the M7, the middle 2 months have 1/3 allocation each, okay? And then the M4 and the M7 are the same kind of dynamic of the M1 M2 over here. So the M4 starts with 100% allocation, well, one third. So one third, that does not get touched. One third of the capital in the fund starts right here. And then every day that goes by in this cycle, it moves a little bit of it over to the M7. So you can imagine what's happening is it's moving some M4 to M7 a little bit each day. And at the end of the month, this one doesn't have any capital left in it and it expires. This one already had one third. This one already had one third. And this one built up one third along the cycle. So now all three of these have one third of the money and it shifts downward. And that becomes the new M4, M5, M6. And the new M7 has zero capital in it. So the M4 starts filtering a little bit of the capital each cycle of the day into the M7. So I guess your general question, why did they do this? They could do whatever they want. It's just a simple calculation. And like I showed before, there's no value gained or lost during this rebalancing. And it's not overly difficult. It's rebalancing a portfolio. Anybody can do that. So you could use anything, right? The M1 and M2 are the fastest moving, fastest reacting VIX futures that there are. So that's why the VXX gets more bang than the ZIV does. That's why I used to love that old ZIV product, because when you get into a trade and you take a losing trade, it doesn't rip your face off if you take the losses. Something like the Volpocalypse event in February 2018, the ZIV, while it wouldn't have been a pleasant day either, you know, down, what was it, like 16% or something, as opposed to the solution, the opposite, catastrophic losses for the front month futures. So the M4 to M7 is flatter, more stable, it's slower moving, it's longer term, and so it's a safer product. But then again, you don't get the bang for the buck. And what do people in the investment world always seem to look for, even though they're wrong to do this? They're looking for all the action. They're looking for the leverage. They're looking for the fast-moving products. Make big profit and show your gains on Twitter, right? So the ZIV never really got any love, and I don't suspect the new ZIVB will do any better. I think it's going to be quite poor. In fact, it'll probably be substantially worse than the old ZIV. So unfortunately, it's just not going to catch on. That's the mentality of most traders these days, is to go where the most action is, and the ZIV is not a sexy product. So I don't imagine it's going to do very well. But it is structurally well designed, and it should be great. If everybody in the investment world could just shift over to that, I think that they would do better long term. Because, of course, the way I always describe it is, if you want to make the best rate of return, you don't try to improve your good times. You try to whittle away at the bad periods and make those not as punishing, right? My token golf analogy for the day. If you want to try to be the best golfer you can be, don't focus on hitting 300-yard drives. Focus on not hitting the ball out of bounds. You're going to be way better off if you just reduce the number of bad shots you hit rather than try to chase the occasional really good shot you hit. Now, the headline is going to be the 300-yard drive. That person who never misses a fairway but only hits it 260s, just bunting it down the fairway, they don't get any headlines, but they probably get a lot of top 10s. And, you know, unless you're Rory McIlroy, the guy who gets all the top 10s is probably the one that's going to be winning the money, right? Do you know who Scottie Scheffler is? Probably not. Do you know who Rory McIlroy is? Probably. Do you know who Tiger Woods is? Probably. Well, Scottie Scheffler is just a top 10 machine, and he's, you know, far and away leading the money list. So that's what I would suggest in investing as well, is try to eliminate the big losing periods. It's far more beneficial than the gains. So ZIVB should actually be the best product on the market. It should be better than VXX, SVXY, SVIX. It should be the highlight of everybody's portfolio. But if it doesn't get the volume, then it's going to be untradeable, and we can't do it. So this would be my, you know, my short pitch to everybody out there, the few, 1,000 people, 2,000 that might eventually watch this live stream. If we could just band together and get that ZIVB rolling, I think it would be better for all involved in the volatility space. Unfortunately, it's probably going to fall flat, just to be perfectly honest. The front month products are just more explosive, and that's what people chase. And I think they're wrong, but that's what they do. So that answered your question. Now let's get to the ones where I can highlight my little thing. I don't know if anybody noticed. I'm pretty proud of this stuff because I'm really old and not tech savvy at all. but I kind of redesigned this chat box. So let me know what you think. I even made it flash yellow and go around the circle. See how simple I am? I have zero programming ability, so stuff like that actually makes me pretty excited. All right, what do you think about trading the 2 to 10 yield curve spread? For me personally, it's a no. I guess the basic reason would be I feel, and I don't know this for sure because it's not really a market that I've gone after and spent any significant time looking at, but it strikes me as slightly more affected by external factors like monetary policy and Fed decisions and whatnot. And anytime you have an introduction of a few additional unknown variables, it's probably not the best target to go after. So for me personally, you actually want to go after what is a free market, so to speak. Always air quotes because, what really is a free market these days? But yes, you want to try to reduce the number of uncontrolled variables as possible. And I do think that when you're trading something like that, it strikes me as rather vulnerable to surprise changes and little intricacies of the monetary policy world. I don't want to go down that rabbit hole. I like trading options because, as I always say, it's, largely speaking, it is an efficient market. And of course, you could make the case that, yes, Fed policy affects options and volatility as well. Sure, it does, but not directly, right? It's not like this announcement is going to do this for sure to the yield curve. There's still that unknown. And I'd rather trade in something that is on the spectrum of nothing is a free market, nothing is totally controlled. I'd like to go as far towards the free market side as I could. So this is interesting. Do you ever look at or use the VX2 over VX8? The way you said that, it sounds like it's an established thing. Like this is a real thing, VX2 to VX8. Is this just something that you do, those two futures? I like relationships. So in that, I don't use this specific relationship, but as I pointed out, not only do I really like the cash VIX term structure for just the values that each one of them brings, but I also very much like looking at the discrepancy and the gaps and the different moving momentum between the metrics as well. So that's kind of what my self-designed cash VIX oscillator is. This is one of my best metrics. And it's essentially that we're using something that on its own, you could use these as nominal numbers, but I like relative values far better. When you start scaling it into percentiles and you start looking at the differences between these two and where these were last week compared to this week, you really start to get some really good information. So I suspect that's what you're doing with VX2 to VX8. You're basically just trying to eliminate the noise of VX1, which is, wild swinging fast product. And maybe you're thinking if you go to VX2, it's slightly more stable. And then a VX8 would be a long-term look. I think this is fine. I think you could have plenty of good information on those two things alone. You're basically looking at the short-term versus the long-term. The only thing I would say is you probably want to bring in that VX8 closer to something shorter term. There's not a whole lot of action happening on VX8, so you're going to get some very bad values, and it's not going to be very meaningful data, in my opinion. So if you did personally, I like to look at the M1 M2 as a constant maturity 30-day future versus the M4 to M7 constant 156 or whatever it is, moving future. Comparing these two things, because not only is that a good time frame, but there's also actual ETFs that are trading directly that relationship. So you're going to get a lot of really good data from that. I don't want to tell you you're wrong, but I wouldn't suspect the VX8 is all that robust for you. So maybe pull that into VX5 or 6 or something like that, or do a combination of 4 or 5, something easy that you can track. Because you're already talking about several months out. That's good enough. One of the ones that I really like, and it's not a huge difference, but the VIX to the VIX3M. You're talking about 30 days on the VIX to 90 days on the VIX3M. But that relationship, and then you could also do VIX to VIX6M if you want. The VIX to 1 year is pretty much garbage because the VIX1Y, the data is definitely skewed there. But these two are close enough that you could use them. Again, on the futures, is there really any action all the way out here? Probably not. It's probably not very meaningful. So I'd pull that in a little bit. But yes, absolutely. To answer your question, although I don't use that, I love short-term, long-term volatility comparisons. I think it's great. All right. Every asset in the long equity strategies are profitable by itself. I mean, if you backtest the asset in one of the strategies alone is profitable in the 12-year period. Best regards. Let me just stare at this one for another couple of seconds. Every asset in the long equity strategies. So you're talking about my strategies. Are they? Okay, there's two ways I can interpret this. And when you're on the fly on a live stream, for any of you who do a podcast or something, sometimes you will whiff on a question, you'll misunderstand it. So I think there's two ways that I could interpret this. The first way is, of course, our VTS portfolio right now has 5 strategies, equal weight, 20% each. The first way is, are you asking me if all 5 of them on their own are profitable long-term? The answer is yes. Of course, yes. One of the things that I look at within my portfolio is, step 1, each individual strategy that I trade has to outperform, significantly outperform the S&P 500 on its own. Just straight up, that strategy versus the S&P stretched out over a rolling 10-year period. It has to outperform the S&P, and not by a little bit, by substantially, both in absolute performance and, of course, more importantly, risk-adjusted performance. Lower drawdowns, higher performance. That's a requirement of anything I put into my portfolio. So yes, of course, all 5 of our strategies do that. But you also want to make sure that the correlations are a little bit lower. You don't want to just do 5 things that are highly correlated to the stock market. So there's more to it than that. But I also have to make sure that each one of my strategies has a safety mechanism that is either safe enough on its own, which is the volatility trend. Remember, we are doing VXX butterflies, basically, and a butterfly structure. I'm going to just, on the fly, just build something super fast. This isn't even something that I would trade. I just want somebody to have a visual here. So 24, 22. Let's ignore the premium that spits out from this. When you're talking about a butterfly, of course, if you're talking about a VXX broken wing butterfly, the high side is capped. So I'm not scared of a massive volatility spike. So like I said, my strategies have to either be safe enough on their own, or the other 4, they have to have mechanisms that can move to safety immediately within one day. I'm not a buy and hold investor. I'm not riding anything off a cliff just because I'm rigid in my rules. It has to have that. So if your question was, are all 5 of them profitable? Yes, absolutely. The lowest performing strategy we have is volatility trend. And it's actually it's a low correlation, negative correlation strategy. So it's not meant to be super awesome, but the performance is about 15% a year for the worst one we have. And then of course, all the other ones as well. The other way I could interpret your question though is, because we're using tactical rotation with several different assets within each strategy, right? VIXM, cash. This cash might move to something else like staples, consumer staples, or, real estate. We've got gold here. We've got utilities here. If your question is every individual ETF that we are rotating in and out of, is that also a terminal positive? That, I guess the answer is technically yes, but not in a smooth line. Of course, when you're talking about gold, I think it's up 1% annualized over the last 10 years. So technically it's positive. But if you trade gold just in the 60 to 90% volatility range, the results get substantially better. So, I mean, on a buy and hold terminal level, none of these are buy and hold. 20-year bonds got absolutely crushed in 2022, but we didn't even enter this position. This is down here in the volatilities below 27 range. I haven't touched 20-year treasuries in ages. It's been multiple years since my strategies got into treasuries. And utilities gets used quite a bit, and utilities do much better than the stock market during market crashes. Gold does much better than the stock market during a market crash. Of course, long volatility does too, and the VIXM is an M4 to M7. So if that's your question, I don't know how to interpret that exactly. Hopefully I nailed one of those two. But yes, everything I do has to be a good performer as a standalone strategy. And then, of course, when you put everything together and you make sure that the correlations are all very low between them, then you get consistent performance, which, not every year. Of course, I have losing years. I'm coming off a losing year. 2022 was no fun for hardly anybody, right? It doesn't work all the time, but the goal is you stretch it out over 10 years. Yeah, my performance is because of those two factors. Everything outperforms on its own and everything works well together. How could it lose, right? Long term, if you give it patience and time, how could it lose? I wouldn't say it's mathematically impossible, but it's very unlikely to lose. So that's how I invest. Hopefully I got your question right there. Okay, next question. Do you use the same formula for other VTS dashboard calculations, such as beta and roll yield? What formula? I'm looking at your questions here. I don't see anything before that. Let me just check the YouTube channel again. I just like to screenshot this. Ignore what I'm doing over here, waving my arms. So we're down to here. You can see how my software doesn't show me every question on my end. So I'm going to try to get into the habit of going back to the YouTube channel and actually, because you can see here you asked this question, but these two aren't showing for me in my Ecamm software. So are you using the daily logarithmic return formula, blah, 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 or the simple return formula for the VTS return calculations in Excel? I want to better understand your approach to returns. So essentially, I'm just using standard geometric compounding of returns. So everything that I do includes trade fees, dividends, all that stuff, all the friction. And I'm basically trying to show what exactly a subscriber would get if they followed my daily signals. So it is, as you showed, it's not it's not like just end of the month divided by such and such. It's a compounding effect. So if you're in the trade, of course, how much would that trade make until the end of the month? Options, same thing. Realized gains only, including trade fees. Everything is calculated. So when you see my performance on the website for the total portfolio solution, that is exactly accounting for all geometric compounding of all the strategies in the proper allocations at that time. And importantly, and I will get to this importantly aspect. Let's go to my website. This is a side tangent. This isn't what you asked, but some people might appreciate me actually spelling this out explicitly because this is just a rampant problem in the financial industry. Maybe not so much. Well, yeah, survivorship bias, backfill bias. It's terrible. When you see this performance, this is not a back test, right? And this is not changed for if I do something different, I don't recalculate it going backwards and show the new thing. This is exactly what every subscriber would have gotten if they followed every signal from every email. So this is actually a really good time to highlight this. Mental note, I should actually do a full video because we have just done something. You can see this one says tactical balanced, but we've actually just this month, so next month on the website, it's going to say tactical volatility. We have actually substituted back our volatility. It took a short break. It's back in the portfolio now. So what I don't do is because this strategy is back in the portfolio and because it's definitely better than tactical balanced, I'm not going to go back and say, oh, well, tactical volatility, if we had held it during this period, it would have done significantly better, which it would have, right? Short vol did do a little bit better than the Dow Jones, for example. I'm not going to go back and change this. This is there forever. No matter what strategies and no matter what allocations and no matter what I do in the future going forward, this will always and forever look the same. There is zero survivorship bias, backfill. Hey, if vol trend turns out to get destroyed and I get forced to remove it from the portfolio, I mean, that happens. Sometimes trading just goes badly. Strategy does well for 10 years, and then it'll drag its feet for a few years, and you're just like, let's just remove it. But I don't remove it from the record. It was still in there, and real people with real money was actually trading it. So yes, this is a massive side tangent, but I use compounded geometric returns as capital would compound, and nothing is ever changed, removed, or added going backwards. So hopefully that answers your question in sort of a real side tangent kind of way. And then you said, okay, then you said, do I use the same formula in the dashboard? No, that's all treated completely differently. For beta, I'm using rolling 5-year periods of beta. And for roll yield, I'm using a rolling percentile system going all the way back to March 26, 2004, which is the launch of VIX Futures. I feel like we don't have much data yet. I mean, you might think that 19 years is a long time. In the investment world, it's not overly long. So I do think that using the entire period is best. But ideally, you'd want a couple bull markets and a couple bear markets. So if something were to happen in the market, let's say that there was a bear market that was just catastrophic, right? Then you might want to start removing the previous financial crisis one. Otherwise, you'd get a data set that is reflecting too much bad and not enough good. You want to kind of balance it out. But right now, we're in no danger of that because 2004 to 2007 was good times. Financial crisis was bad times. 2009 to 2018 was good times. And then 2018 to now is rough period in the volatility space. So we've got a really good, evenly matched data set. So I just use the whole thing, rolling percentiles all the way. What ETF tends to be profitable with selling iron butterflies? I'm considering EEM, any other indices sectors. So when you're selling an iron butterfly or an iron condor, there's really no difference. It's just, is the juicy premium at this moment at the money or is it out of the money? Again, do I even have it in the dashboard anymore? Let's see. What I'm trying to go after is the VIX minus volley. I removed it. Okay, maybe I'll throw that back in there. VIX minus volley, right? It's just a very simple way to measure where the at-the-money premiums are. You can use the TDEX, SDEX, all that stuff. But what was your question? What is profitable? Well, I mean, the ETF itself doesn't matter. The ETF itself, for all trading, like my VXX Wheel of Fun, I mentioned that I don't care what the VXX does. I'm just using that as a vehicle for premium generation. So I would look at your Iron Fly strategy the same. It's not that the ETF you chose is bringing you the profit. That's not what you're looking for. What you're actually looking for is something that, of course, on its face has higher volatility. You're not going to want to sell iron flies on something with persistently low volatility or something that's low vol right now because it is a short Vega trade. And if you get something that moves on you, well, your wings are going to be very narrow and you're going to get stopped out very quickly. So if you're selling iron flies, step one, you need to sell it on something with higher volatility. So I don't care if it's the EEM, you just kind of filter through 10 or 12 ETFs that you typically go to and see which one has the higher volatility. When I'm doing equities, for example, I'll just go through the big four. I'll go through the SPY, the Qs, the Dow, and then the IWM, the Russell. And whichever one has the high vol, because they're all basically, the volume's good on all of them, just go with the higher volatility one. That's going to be the best Iron Condor. EEM sounds fine because it's kind of a wild ride sometimes. So yeah, you'd probably do well there. The only thing you're going to run into is, I think EEM is roughly 12th to 15th in the volume, the options trading volume. Another thing that I can do here, I don't know if I could say I love plugging my stuff. I typically don't. I shy away from this. For some reason in this live stream, I had an opportunity to do 3 or 4. But we have an Iron Condor course, 30 video Iron Condor course. Let me screen share here. Anybody who signs up for the free trial at VTS gets immediate access. So if you can consume content quickly, you could get through all of this and then the free trial would be done. But where is it? One of these lessons is very specific to this one, options trading on ETFs and indexes. This video basically goes through the data on which ETFs are going to give you the best volume, right? And EEM is in there, so but it's not, oh, it doesn't show me. I was hoping I could just, oh, there it is. It's moving. Let me see if I can get this ETF list. I feel like it's this video, but if I got the wrong video, then I'm going to look stupid. I got the wrong video. One of these 30 videos, let me regroup here. One of these 30 videos is specific to your question. The EEM volume essentially is okay, not great. If you're trading your own capital and you're trading a few contracts, it's fine. But you're not going to get $5 strike gap, of course. If you're targeting 15 deltas, for example, which is what we typically do on Iron Condors, you're doing Iron Flies, so you're at the money. It'll matter a lot less. But your wings, you're not going to be able to be very specific on your targeting. You're going to get a pretty wide delta range on those. For the SPY, you can get delta 16, 15, 14, 13, all the way down. For the EEM, you're going to get like 26, 21, 15, 12. You know, it's not perfect targeting there, but you can do it. I would say get a list of the top 10. First of all, sign up for the free trial, watch those videos. One of the videos gives a list of those things. Get your list of 10 and just top to bottom, check the volatility, whichever one's highest or near the highest. That's your target for this month. And then the next month, it's the same thing. You don't want to just do EEM all the time. That's, how is it ever going to work out that one ETF covers all your needs? You need to structure each individual trade to have the highest probability of success. So it has nothing to do with the ETF. That's just the vehicle to get the volatility rolling into your account for you. Don't really care what those letters say, if that makes some sense. Oh, hey. Wow, you made it live. You always say that you can't make it live. Will the tactical volatility start trading for VTS members? And when we'll find out replaces strategic. Nothing replaces strategic tail risk. So this is a little bit specific to VTS, but my friend here is asking a question. I'm obviously going to answer it. Well, first question, top question first. Oh no, well, that's a mistake. Of course, we're in cash. This is not supposed to be there until we take our first trade. I hope nobody got confused by there's trade signals with no trade. This should be gone. Anyway, we just replaced this back. This is a strategy that's been with VTS since 2012, live all the way up. It's basically only skipped 1 year of the 11 and a half years we've been live. But it's just back in the portfolio now because the market is just starting to now recover. Volatility's getting comfortable into these lower ranges. So the short vol trade, I would say, is back. So the strategy is back. The only reason we haven't jumped into a trade yet, I haven't fully decided on two things. So I'll be quick because most people watching probably aren't VTS members. But the first reason, I was kind of waiting for the fresh new signal. So I was hoping that volatility would flash above sort of 55, 60. We'd get into gold, and then we would initiate the full strategy from that moment. But so far over the last 2 weeks, it's kind of just bounced around in the SVXY. I think it's only up 2%, so we're not missing much. But the other thing is, spoiler alert, I am going to be deleveraging the strategic tail risk down to the one-time SPY. So probably going to replace this with a ETF. Again, I'll introduce that fully. There's a list of 10 or 12 that we could choose from. I've chosen one. But I'm also going to deleverage this because what we don't want is 2 times NASDAQ, short SVX or long SVXY, basically short vol, and 2 times S&P 500. I feel personally that's a little bit too much leverage. I like using strategic leverage when possible, so the 2 times Qs are absolutely crushing it for us, but I don't think we need 3 strategies that are fast movers. So yeah, that answers both of those questions. Glad you could show up. That's awesome. I know the timing is not great. Both VIX Futures and VIX, I should give you guys. Both VIX Futures to spot VIX price and Contango have some effect on the price of VXX over time. Yeah, have some effect. But again, maybe I'm just a stickler for semantics, but there's no causation there. It's just, yeah, sure. If the VIX Futures are in Contango for an extended period of time, even 2-3 days, it's slightly more likely. If it's 2 weeks, it's even more likely. Now we've been in Contango for 185 days straight. Yes, obviously the volatility products are going to be decaying downward under that condition. But again, it's not useful to say that it's causing it. What is causing it is the totally free and fair market of VIX futures. That's it. Monday, everybody can trade the VIX futures any way they want. That's it. It's a freely traded market. There is no, if it's in Contango, then that's going to mean that the VXX gets an extra drop down. No, it doesn't work that way. If the cumulative volume in the VIX futures have decided to push them up, then the VXX is going to go up. It does not matter if it's in Contango. That's the point, is that we need to look a little bit deeper than that. So you're not wrong. Of course, I don't mind if you use the word influence. I don't mind if you use the word correlation. I just don't like when people say this causes that, because that is not true, right? And I don't think it's, from a trader's perspective, not a good way to look at it. Could you please inform us when the extreme put-call ratio indicator will be available again for members? It's not probably ever going to be available. Well, I wouldn't say ever, but as you can probably imagine, the put-call ratios have become, I won't say totally obsolete, but certainly vastly diminished in their robustness lately. This 0 days to expiration options, it's made some of our metrics, not ours, just the markets in general. There are some things that have had to been shuffled around and adjusted, and put call ratios have obviously been affected a little bit by that. And I'm not sure that I don't personally look at it very much anymore. And so what VTS tends to be, and I'm not saying I won't throw it in there for you if you want, I would feel bad giving data for something that I don't personally use. VTS is just my portfolio. I'm managing my money as the best way that I can. That portfolio, it's not designed to get, oh, maybe if I do this, people will think I'm popular and they'll come give me money. It has nothing to do with me designing something to look good in front of other people. It's I'm designing my portfolio to perform the best it possibly can for me. Selfish 100%. I'm trying to maximize my bank account. That's what VTS is. And by proxy, anybody who follows my work, well, hopefully you're getting the performance that I'm getting as well, and everybody's happy. But I'm not doing anything to appease a community or to, oh, this metric, they'll think this one's awesome. Secretly, I don't really use it, but I'm going to give it to them anyway because it sounds so cool. That's what most other people do. They basically do things that sell well on Twitter. So for me to give you something that I don't think is robust anymore, that would be unethical, right? In my mind. If you force me, I don't know, maybe I'll email you something, but I don't think it's useful anymore. Let's move on. Not everything lasts forever. I think this is a good lesson. It's the same thing as a certain strategy. You might have something that worked very well for you in the past that just stopped working, right? It could have stopped working because it got drowned out by market conditions. It could stop working because, you're in a different regime and it's just not suitable for that. Stop working because the product itself is delisted, like ZIV. You might have had a great M4 to M7 smooth product, and then, well, now you're trying to jam in the M1 M2 futures to something that was designed for something else. Not everything works forever. I think put call ratios, at least the way that the market is sitting now, I wouldn't trust that data very much. It's too different from the previous 10 years. You've got a 10-year chunk that's this, and then you've got this new market dynamic that shifts all the data. I would rather not scramble around and try to figure out a way to make it work. I would just say, look, I've got 20 other things that are just as good. Let's just focus on that. I think I just answered this, but you probably asked it after. But yes, it'll go soon. What happens when my options expire out of the money? Nothing. Let's say I got in using regular long puts, butterfly or verticals for debit. Do I need to close my position or let them expire? Well, technically speaking, anything that expires out of the money is just out of the money. Nothing happens. The option is cleared from your account over the weekend, and Monday it'll just be gone, right? In the money, I've got actually a full article that people can read. If something expires in the money, you're going to be assigned the shares, sometimes long, sometimes short, but you're going to be assigned something. So that's what you don't want to happen. So we trade VXX butterflies. There's 3 legs in a butterfly, and we don't want any of those 3 legs to expire in the money, because you could get assigned long shares or short shares of the VXX if that's the case. So you have to close out everything that's close to in the money. Now this gets to where it's sort of a judgment call, like what is close enough to the money? Because you have to remember that there might be a discrepancy between market close and the aftermarket period. You don't want to wait until it's 1 penny. If it's going to be anywhere close, just kick in the trade fees and just close the thing, right? you don't want to get into a situation where I don't know, you live in the West, so you're probably normal market hours, but I'm sort of like I live in Taiwan. The market closes at 5 in the morning sometimes. I'm in here in Dubai. I think the market closes at midnight. You don't want to go to bed thinking, oh, everything's fine. And then you wake up the next day and you realize, oh no, big late market move. And look at that. Now I'm assigned something I didn't want to get assigned. So if it's going to be anywhere close, just close the thing. That's what I would say. And for butterflies, just to give one more final point, there's 3 legs. If you wanted to make the judgment call, there are times when maybe you only have to close one of them because the other 2 might just expire worthless anyway. So if you're just barely knocking on the door of the farthest strike and these ones have no chance, there's only an hour to go and there's no way they're getting there, then you could just close out the 1 leg, right? And then over the weekend, options get settled and removed from your account and everything's fine. So don't let anything expire in the money for that strategy. Every strategy is different. The Wheel of Fun, I let them go because I want that assignment. I want those shares. For the volatility trend butterflies, we do not want to mess around with VXX shares. Second interpretation. Okay, gotcha. So if it's the second interpretation, then the one you want to look at is gold. I think now gold's had a decent run lately, so gold's up in the last 12 years, but it's close. That's a pretty garbage asset. We only use it when volatility is very elevated, and gold is a pretty decent sort of 4 to 5% per year performer for that strategy because of when we're using it. But boy, I feel bad for people who buy and hold gold. To my gold bug friends out there, I'm sorry about that. That's got to be painful. All right, so I think we got through all of them. Cool. All right. Decent timing too. So I'm actually pretty excited about the leveraged volatility live stream, or the leveraged ETF one. And I might just skip that for next Friday. But if I really, really want to do it, then maybe we'll do a live stream Tuesday, Wednesday, something like that. So thanks, everybody. If you would be so kind, give the video a like on your way out the door. There was way more viewers than likes. So I want to get to the point where everybody kind of knows that likes help YouTube, right? You might not like it. I think it's stupid. I hate asking, but the like button helps on YouTube. So go ahead and do that and have a great weekend.